Hello traders, you are welcome back to the Forex Geek channel. Have you ever found yourself stuck in a sideways market with no clear trend? Instead of forcing trades or relying on lagging indicators, there is a simple and effective way to trade ranging markets using price action alone. So in this video, I'm going to break down the price action range trading strategy, a method that lets you identify high probability trade setups without cluttering your charts with indicators. By the end of this video, you'll know exactly how to spot key levels, time your entries, and manage risk like a pro. So make sure to stick around till the end, and if you are ready to level up your trading, smash that like button and subscribe for more price action strategies. Now, before we dive into the strategy, let us talk about what range trading actually is. A range bound market is when price moves sideways between two clear levels. All right. When price moves sideways between two clear levels, you have a range bound market. The two clear levels we're talking about are resistance and support. Okay, so price moves within the resistance and support without forming a strong trend. Instead of making higher highs or lower lows, price bounces back and forth, creating tradable opportunities at these key zones. A lot of traders struggle in these conditions because they expect big trends. But with price action range trading, you are trading within the range, not waiting for a breakout. So now, how do you trade the price action range strategy? First, you need to confirm that the market is actually ranging. Okay, the easiest way to do this is by looking at higher time frames like the 4-hour or the daily. You can see this is the daily chart. Okay, you are looking at the higher time frames to spot key support and resistance levels. If price has been bouncing between two levels multiple times without breaking out, then you have a range. The second step is to wait for price to reach key levels. Once the range is identified, the next step is to wait for price to reach either the support or the resistance zone. This is where we look for potential buy or sell setups based purely on price action signals like pin bars, engulfing candles, or rejection wicks. Then the third step is to enter the trade. Here is where patience pays off. Instead of entering as soon as price touches support or resistance, you wait for confirmation. For a buy setup at support, you look for bullish reversal patterns. For a short setup at resistance, watch for bearish rejection candles. All right. Then the fourth step is to set your stop loss and take profit. Risk management is key. So always place your stop loss just outside the range to avoid false breakouts. Then for your take profit, the safest approach is to target the opposite end of the range, buying at support and selling at resistance. All right, so if you buy at this support, you can set your stop loss below the support and target the resistance for your take profit. If you sell at this resistance, you set your stop loss above the resistance and target your take profit at the support. Okay, then the final step is to watch for breakout. Sometimes the range will eventually break in one direction, like what we can see happen here. All right, the range is not going to last forever. Okay, so the range will eventually break in one direction and a new trend will form. If this happens, do not force range trades. Okay, just adjust your strategy to trade the breakout instead. Now, unlike indicators that lag behind price movements, pure price action trading gives you real-time signals. Okay, and here's why it works so well for range trading. One, it is simple and clean, right? As you can see, your chart is simple, clean, easy to read. No unnecessary indicators cluttering your chart. Just support, resistance, and your candlestick signals. Also, this strategy works in any market, whether you trade Forex, stocks, or crypto. Price action is universal. Okay, you can use price action across any market. All right, and then finally, this helps you avoid false signals. So instead of relying on overbought or oversold indicators, you are reacting to real market structure. Now, I am not trying to undermine indicators, right? Indicators are also good and they have their benefits, they have their advantages as as well, in addition to their disadvantages. So sometimes, some traders like to, add indicators to price action, but if you understand price action properly, you can actually trade with price action without even adding other indicators to it. Once you understand your candlestick patterns, your chart patterns, know how to use your support and resistance levels, know how to use your trend lines and all of that, you can actually trade comfortably using pure price action. Okay, you don't have to rely on indicators. When you understand market structure, remember that when we're talking about market structure, bearish trends are usually formed by lower highs and lower lows, right? These are what defines bearish trends: lower highs and lower lows. Bullish trends are defined by higher highs and higher lows, right? So what defines bullish trend? Then what defines a consolidating market or ranging market is when price is just moving sideways, no higher highs or higher lows, no lower highs or lower lows. All right. So that is how you master the price action range trading strategy. This is one of the best ways to trade sideways markets without relying on indicators. If you found this video helpful, hit that like button and subscribe for more powerful trading strategies. Let me know in the comments, do you prefer range trading or trend trading? Thank you for watching, and I'll see you in the next video. Happy trading.